keeping all of your money in your bank account is actually more risky than it is safe. Now, I get it. Most Americans don't have $1,000 to protect them against an emergency. That's not who I'm talking about. I have plenty of videos on my channel where I go over how you can save your first $1,000, and I'll link that for you down in the description. But many people, including many of you, have tens of thousands or hundreds of thousands or even millions of dollars sitting in your bank account earning 0.4% in interest a year, which means the $12,000 you have sitting in your savings account is going to buy you less stuff 12 months from now because your savings are not going to grow as fast as the prices of things because of inflation. And this matters more than ever today because the Federal Reserve Bank, which is the central bank here in the United States, just started cutting interest rates again, which means the interest rate that you're going to be paid by your bank on your savings is going to be dropping while the prices of things are going to continue rising, maybe even faster than before. But not anymore, because in this video, I'm going to show you how to save your money strategically. That way you can continue growing your wealth despite the inflation happening. So let's break it all down. When you have extra money, you can save it in the form of cash or you can save it in the form of assets. Now, every financial advisor, every accountant is going to lose their minds when I tell you this, but I'm not going to categorize these cash savings accounts as investments. That way you can understand the difference. Now, when I say saving your money in cash, that means putting your money in something like a savings account or a checking account, putting your money into a bank CD, otherwise known as a certificate of deposit, putting your money into a high yield savings account, putting your money into a treasury, that means lending your money to the United States government, or putting your money into a treasury ETF, or putting your money into a secret spot like under your mattress or a sock drawer. What you're doing here is not actually buying something that's working to grow in value. You're putting your money into a thing that's going to generate you some interest, except you're not going to get any interest when you put your money in your sock drawer. So you put your money into the bank account, and then the bank is going to pay you a little bit of interest. How much interest are we talking? Well, the average savings account in the United States today is paying 0.4% a year in interest. The average CD is paying 1.34% at the time I'm recording this video. The average high yield savings account is paying around 4%. The average treasury, 2-year treasury, is paying 3.5% a year, and a short-term treasury ETF is paying around that 4 to 4.4% a year in interest at the time we're recording this video, and your sock drawer is paying 0. Now, what you also need to remember about these treasuries and treasury ETFs is you're lending your money to the United States government. So there's two things you have to understand. Number one, because you're generating income from the United States government, this interest that you're getting here is not going to be taxable at the state and local level generally. So some people, especially people that are more tax savvy, will use these as ways to generate income and pay less money in taxes. And the second thing you have to remember is that these accounts are not FDIC insured because you're not putting your money in a bank. So here, when you put your money into a bank, whether it's a high yield account, a CD, or a savings account, you have FDIC protection, which means if the bank were to go bankrupt, your money is protected up to $250,000. Beyond that, well, it's not necessarily protected, although we've seen government bailouts happen in the past. When you invest your money into a treasury, now you don't have that FDIC protection, but it's backed by the United States government. So if the United States government were to default and not pay back their bills, you wouldn't get your money back. But that's probably not going to happen, at least not in the short term. Instead, what the government is more likely to do is work with the central bank, the Federal Reserve Bank, to print money to pay back their bills, which means you'll get the money back. It just might not be worth as much money as before. All of that gets a little bit more technical, but the whole idea here is that the difference between these and these is here with treasuries, you're not actually putting your money in a bank. You're lending your money to the United States government and you're protected by the United States government. Here you're putting your money into a bank and you're protected by the FDIC insurance, which is also backed by the United States government. Now, while this interest sounds great, you need to compare the interest that you're getting on your money with the inflation rate in the United States. The reported inflation rate at the time when we were recording this video is right around 3% a year, which means on average, according to the reported numbers, the prices of things are going up by around 3%. Now, the key thing I want you to understand about this is, number one, if you are growing your money at a rate less than this, that means effectively you are becoming poorer because your money is growing, but it's not growing at the rate as the prices of things. So prices of things are getting more expensive faster than your money is growing. So you have your money in your savings account and it's not growing fast enough to keep up with inflation, so you're slowly becoming poorer. The second thing you want to understand is this reported inflation number might not be your real inflation number, because maybe you spend more money on groceries and your rent and your car than other people. And the inflation rate that many people feel, according to the general rule of thumb in the financial space, is that take this reported inflation number, multiply it by 2, and that is oftentimes the real inflation rate that many people are feeling. So if your money is not growing by 6%, well, then you might not be seeing your savings grow fast enough to keep up with the price growth of things that you are paying for. That's why it's so important to understand this, because many people have a lot of cash here. In fact, some people have all their investments here, thinking that they're doing the safe thing, when in reality, that safe thing can oftentimes be a guaranteed loss, which is why you want to understand how and when to use this strategically and when to invest your money. So let me go over what are different types of assets that you can invest in, and then let me go over how you can save your money strategically, that way you do it smartly. And I also want to remind you that for those of you that are investors or want to become investors, I have put together a brand new free investing masterclass where I walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. And I'll also share the exact framework that my firm and I use to research investment opportunities before they hit the headlines. It's completely free. There's a ton of value in this masterclass. So if you want to get the masterclass, all you have to do is click the link down in the description below to register. And when you do, you're also going to get access to Market Briefs, which is my newsletter for investors, completely free as a bonus, complimentary just for joining. So you can get the investing masterclass and Market Briefs all for free just by clicking the link down in the description. When I'm talking about assets in this video, I'm talking about stocks, real estate, investing in gold, investing in crypto, investing in startups. These are more risky than putting your money here, but with more risk, you also get more potential return. For example, historically, the stock market and the real estate market have grown by around 10% a year over the last 100 years. So that's definitely higher than the inflation numbers, which means when you put your money into those assets, assuming you find good investments, well, not only do you have the ability to keep up with inflation, but you're actually becoming wealthier because your wealth is now outpacing inflation. And if you're wondering, again, how do you invest your money? Remember, I just talked about that investing masterclass where I break it down all in there. But a couple of these assets, crypto and startups particularly, are much more on the speculative side, meaning they're more volatile. You can see big swings up and down, and you can have more risks because, well, when you invest in startups, many of those startups will fail. With cryptocurrency, it's a much newer asset class, and we don't know what it's going to look like in 20, 30, or 40 years, versus stocks and real estate have been around for many, many decades. Gold, on the other hand, is a little bit unique because I don't like to talk about gold as an investment per se. I talk about it as a way of saving hard money. But gold has been seeing a very strong bull run since 2020, meaning it has gone up a lot since the 2020 pandemic. And a lot of people are very excited about this movement in gold. Just understand that unlike stocks and unlike real estate and unlike startups, that gold isn't actually producing value. It's not going out and producing a profit. It just sits there and looks back at you. Not saying it's a bad thing, but understanding how it plays a part in your investment portfolio because it is different than other investments. And this is where many people, especially high income earners who want to be financially savvy, get a little confused because they don't know what to do with their money. You're making a lot of money. Maybe you're a doctor. You're making a few $100,000 a year and you live small. So you have all this extra cash, so what do you do with it? Well, you don't want to invest it because you don't know how to invest. You've never invested your money before, so you just keep saving that money. And it's better to save that money than buy a whole bunch of stupid stuff. But now you're saving that money, and this is where a lot of times people don't realize that you're actually getting hurt because you're saving that money here and you're getting a little bit of return, which is nice, but you're actually losing relative to inflation. But the problem is if you invest your money in the stock market, well, what happens if the market crashes? What happens if you pick a bad investment? How do you actually invest your money? So let's talk about this, starting with, well, how much should you be saving and where should you be saving? And then how do you invest your money to be a little bit smarter with those investments? Every time you save money, it has to be done with a purpose. And there are 3 reasons why you should be saving money. Number 1 is you want to save money for an emergency. Number 2 is you want to save money for a big purchase. And number 3, you should save money for an investment. And this should be done in different bank accounts because you don't want to commingle these things. We're not talking about saving money for an emergency. What every financially savvy person does is they have a separate account called a rainy day fund, an emergency fund, call it whatever you want, where it's extra cash to protect you in case something bad happens, in case something happens to your house, something happens to your car, you lose your job, something happens with your family, gets sick. You have this extra cash to protect you so you don't have to worry about how you're going to pay this expensive bill. The amount of money you need to have in this emergency fund will be somewhere between 3 to 12 months, depending on where you are in your financial journey. And when I say 3 to 12 months, I mean 3 to 12 months of your expenses. So if you spend $5,000 a month, Well, take the $5,000, multiply it by 3, which is $15,000. Take the $5,000, multiply it by 12, which is $60,000. And that's the range of how much cash you need to have to protect you against an emergency. So you figure out how much your monthly expenses are, multiply it by 3, multiply it by 12. That's how much money you want to have in this emergency fund. And the amount of money you're going to save is, again, going to depend on where you are, because if you're 23 years old, you're just starting your financial career, you don't need 12 months worth of emergency expenses because you probably don't have a lot of responsibilities financially. But if you're 45, you got kids that you got to take care of, you got parents you got to take care of, and you have a whole bunch of other financial responsibilities, maybe you won't feel so comfortable with 3 months of savings put aside. Maybe you need 6 or 9 or 12 months of savings there to protect you. But beyond 12 months, that's enough. You don't need more than 12 months, because if you were to lose your job and a lot of bad things happen, you can continue living your life for a year to get back on your feet financially and not have to worry about a thing. So 12 months worth of expenses max. And this emergency money, again, is not there to make you wealthy. This is there to protect you against an emergency. This money can be stored somewhere here, and ideally someplace where you're going to get at least some sort of interest. I mean, a high-yield savings account is great. A treasury can be great. These are places where now you can generate at least some interest. Again, you're not trying to become wealthy, but you can generate some interest. That way the money is at least doing something instead of just sitting there flat. Now you might be wondering, well, Jaspreet, why don't I just take this emergency money and put it into the stock market? And the reason why is because, well, the stock market goes up and down. And now if a bad thing happens, like you lose your job during a recession and the stock market has fallen by 50%, well, now your savings have also been cut in half. That's why these savings need to be put somewhere safer, where they're not going to be growing very aggressively because it's low risk. That way you can keep the value of those savings, even though you might not be beating inflation. Then, when it comes to saving money for a big purchase, maybe you want to buy a car, you want to buy a house, you want to buy a watch, whatever it is, you want to have a separate account to control and own that money. Now, this money is going to sit there for whatever you want to purchase. And again, use one of these cash accounts to save this money if you don't want to see the value of that fall. Then when it comes to saving money for an investment, what I do is I have separate accounts for my investment cash that's waiting to be invested. And what I mean by that is I invest my money into stocks, invest my money into real estate, invest my money into startups, and I have different bank accounts that are holding the cash that is going to be invested for each one of those things. And when I have that cash sitting there, it is sitting in an account generating interest. Things like high yield savings accounts that are generating some interest while it's waiting for an investment opportunity. Now, this doesn't mean that I'm waiting to invest all of my money. I'll talk about my investing strategy in just a minute. But the cash that's waiting to be invested, that is earning some interest as I'm waiting for a good opportunity for this cash to be deployed, my money that's going to be put into an investment. So keeping this in different bank accounts is one of the easiest ways to organize your finances. I know it can be weird having so many different bank accounts, but I have found that to be the simplest way to organize the money. And no, you don't need millions of dollars to justify having different bank accounts. Even if you have $100 or a couple $1,000s in the different bank accounts, it'll keep your finances organized, and now you know where your money is for each purpose, and then you can allocate this extra cash in the right place. Now, once you've done this, what do you do with the other cash that you actually wanted to become wealthy with? Now, a minute ago, I was talking about how I have money put aside that's waiting to be invested in the stock market. But that's not the only way that I invest in the stock market. And what I mean by that is, in general, there are two strategies that I like to follow when I invest my money. And I can't tell you what to do. I don't recommend what I do to anybody else because I'm not a financial advisor. I'm just a random guy on YouTube. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But the two strategies to invest your money are being an active investor or passive investor. An active investor is when you want to manage your own portfolio and find the investments that you want to do. So, for example, in the stock market, this would be investing in individual companies. You want to invest in Amazon or Nvidia. That is what active investing is. Passive investing is when you have an automatic contribution or money being invested into your funds that are being managed by somebody else. So there are funds out there like mutual funds and index funds and ETFs, all different types of funds where now instead of investing in one company like Amazon or McDonald's, you're investing into a basket of companies. It might be dozens of companies, it could be hundreds of companies, it could even be thousands of companies. That way now it is managed by that manager, and you don't have to worry about a thing. And I'll just give you a couple examples. VTI is an ETF, again, a fund that you can invest in on the stock market that will give you exposure to the total stock market. So if you just wanted to invest your money in the markets, well, VTI will give you exposure to the 2,000 some stocks in the stock market. If you wanted to get a little bit more niche and you wanted to invest in, say, the S&P 500, which is a group of the 500 largest companies in the stock market, there are funds that will give you exposure to that. For example, SPY, SPY. This will give you exposure to the 500 largest companies in the stock market. Now, Amazon is part of that S&P 500. So if you wanted to invest in the S&P 500 and you bought SPY, you would also own some Amazon. And if Amazon started to do really bad and they were no longer a large company, well, you wouldn't have to do anything because then SPY would kick Amazon out and replace it with a different company, so it's passive for you. If you wanted to get a little bit more niche, then we have QQQ. QQQ gives you exposure to the NASDAQ 100. That is the largest 100 companies in the stock market that are not financial. So when you have those 100 largest companies that are not financial, those are generally tech companies, so a lot more tech heavy, more growth potential, but also more volatility. So when you see market crashes happen, generally QQQ goes down even further. But because there's so much money flowing into tech, it creates more upside potential. More risk, more volatility, but also more upside potential. The way you win as a passive investor is just to keep consistently investing your money every week, every 2 weeks, or every month, and you create a system where you set it and forget it. I call it ABB. Always be buying. When you have that type of system as a passive investor, it has been proven over the last number of decades and century that it works to build wealth. As an active investor, again, this is where the cash is being put aside until you find a good investment opportunity. And while the cash is waiting, I like to generate a little bit of interest on the cash. That way, well, at least it's not sitting there doing nothing. But there's one more reason why this is more important now than ever before. So what we've talked about so far is that you need to save your money strategically, because if you just save all of your money just to save it, well, your savings are going to be losing value to inflation. Either they're going to be losing value to reported inflation, or you might be losing value to the real inflation that you're actually feeling. So we talked about the different ways that you can save your money in cash and generate a little bit higher interest. Again, some of these are in banks, savings accounts, CDs, and high-yield savings accounts. These are different ways to have your money protected by FDIC insurance. If you're saving your money here, you might as well save your money in a high-yield savings account. I mean, it's free to open a high-yield savings account and you generate some more interest. Or you can put your money into a treasury or a treasury ETF, which will also give you some better returns than a low interest paying savings account. And now you're not protected by FDIC, but you're backed by the United States government. If you're going to be saving your money in cash, you need to know why you're saving that money. And we talked about saving your money for an emergency, somewhere between 3 to 12 months of monthly expenses. We talked about saving your money for a big purchase in a separate bank account. We also talked about saving your money to make an investment. When you're saving your money to make an investment, that means you are saving your money as an active investor waiting for a good investment to be made. And while your money is being saved as an active investor looking for a good opportunity, this is where you can generate some interest on those savings. If you want to actually grow your money, grow your wealth, not just to keep up with inflation, but also beat inflation, well, that's where you can use assets. Some assets are going to be more speculative, more risky than others, but you got to find what's the right type of investment for you. Again, it could be more of a passive investor or an active investor, but the reason why this information is so much more important now than before is because very recently the Federal Reserve Bank has begun cutting interest rates in the United States, which means two things. Number one, if they're cutting interest rates, that means that you're going to be getting less interest on your savings, because the interest rate that's set by the central bank, the Federal Reserve Bank, then dictates how much money and interest your bank is going to be paying you. Number two, generally, what history has told us is that lower interest rates can contribute to higher inflation, which means if the Federal Reserve Bank is going to continue cutting interest rates in 2025 and 2026, which is what they've been hinting at, well, that could also make the inflation problem worse in 2026, which means you could be generating less interest here while the prices of things are going up even faster, which means it will become even more important for you to understand this, because now your savings may not be able to keep up with the reported inflation numbers, which is more reason for you to understand this. Now, it doesn't mean that market crashes don't happen. It doesn't mean that recessions don't happen. They are a part of the economic system. And when you understand how market crashes and recessions happen, you can capitalize on them, because the reality is market crashes and recessions create more millionaires than any other time. Why? Because good investments go on sale. In 2022, the stock market fell by 20%. Smart investors were buying. In 2020, The stock market fell by 35%. Smart investors were buying while most people were selling. During the 2008 crash, real estate prices were decimated and the stock market fell by another 40%. Again, the financially savvy investors who were prepared were able to buy good investments at a discounted price. And this is where, when you understand this, you can have a longer-term horizon, longer-term investment mindset, and not get caught up in the short-term recessions, the short-term swings, and use them as opportunities to buy more long-term investments, because that's what can help you accelerate your wealth even faster. Which means all roads lead back to being a financially savvy investor. Again, I have my free investing masterclass for you down in the description if you want to learn more. And if you got value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, a family member, a colleague, or a fellow investor. Thank you. The United States government owes more than $37 trillion. That means your tax dollars are being used to pay interest on all that debt. And this is where President Trump has been proposing a new plan to help pay off this debt, involving gold and involving crypto. And most people have no idea of how this plan works or the implication of this new plan on your money.